Yes, that's right. And so today I'm going to talk about Elliott Wave analysis. Okay, and basically I introduced myself last time, so I'm not going to spend much time about me, but I've got 20 years experience in the market. And I've been there, in all kind of markets. I remember the technology bubble in 2000 and the financial crisis later, a few years ago. And, it's good to be in those situations because you learn a lot, when the market is moving fast, when it's crashing, when you get those huge counter-trend rallies. I've been in all situations. And my analysis is based on Elliott Wave analysis. And Elliott Wave analysis, for me, is the best analysis you can find because it is actually how the market moves. So I'm going to show you a few examples on Elliott Wave, but at the same time, I will also talk about a low-risk strategy, and that strategy is based on the FTSE 100 index, which is my favorite market. I also look at other markets, not just the FTSE. I do Euro-Dollar, gold, cable, Wall Street, S&P 500. But my main market is a FTSE. So this low-risk strategy, what I mean by low risk is that you can make some very good returns, but at the same time, you've got some kind of protection. Your money is protected. We can never say 100% risk-free because in trading that doesn't exist. But that strategy is very solid. It means that you can sleep well at night when you follow the signals. It's based on Elliott Wave analysis. It's low risk. I use some momentum and timing indicators. And also I do some hedging, which means protecting position with other trades. But first I'm going to show you the basic pattern, the basic Elliott Wave pattern. And that pattern is in 5 waves. So what I mean by 5 waves, when the market moves up, like say for example in a bull market, rallies will be in 5 waves. So we got 1, 2, 3, 4, 5. So in a bull market, it's going up in 5 waves, and when you get a correction, that correction is in 3 waves. And that is a pattern on the right. A, B, C, we call it. A, B, and C. Okay, so this is a basic pattern. There are many other variations, but this is just the basic one. So the important thing to remember in Elliott Wave is when the market is up, it's going to move in 5 waves. And when it's down, it's the opposite. It's going to decline in 5 waves. This Elliott Wave analysis was discovered by an accountant in the 30s. His name is Ralph Nelson Elliott. And he became a stock market analyst because he noticed that the stock market moves in a recurring pattern consisting of 5 waves and 3 down. Okay, so it's like 8 in total. And he noticed also that this repetitive pattern happen all the time and in different time periods. For example, you can see the 5 wave up on a daily chart, and when you zoom on one of the waves, for example, by going into like an hourly chart, you will see that also there are 5 waves. So it's the same pattern, but in different time periods. And as I said at the beginning of the presentation, once you master the Elliott Wave, you will notice that all markets follow that pattern. Of course, at the beginning it's not easy to see the patterns, but after many years experience, it becomes easier. And it's really a great advantage. And I will show you some example how to identify those tops and bottoms and where to enter the market, where to put your stop loss. But first, what I was saying about Elliott Wave is that it's like a recurring pattern. And you can see that on that chart. This is a very good example because we are looking at the S&P 500. And what we have here is a rally that is in 2006. We have a rally in 5 waves. And then we've got to a spin. Then the marks a new retest of the trend line, support, and a breakout. So the market is done, and we've got a, if you look at the pattern on the right, which is like in 2010, 4 years later, with the exact same thing happening. We put in 5 waves here, a pullback and a test of the support line. Then you put a new high, another test, a lower high, and so it's a very, very similar pattern happening at 4 years interval. This is what I mean by history repeats itself. Once you master the Elliott wave, you can use past pattern to identify future patterns. And right now, I'm going to talk a bit more about these 5 wave patterns. As I said, the most important thing about Elliott wave is recognizing the trend, and you do that by counting the waves. So for example, when we have 5 wave ups, it means the trend is up. And when we get to the top of the 5th wave, we get a decline in 3, and we label it A, B, and C. So basically what happened after that wave C is that if we are still in a bull market, the market will move up again in 5 waves and correct in 3 waves and move up in 5 waves and correct in 3 waves. Okay, so that's the basic pattern. And on the picture on the right here, you can see that it is occurring at different time periods. This is what I was saying earlier. And this is a good representation of the pattern at different time periods, because when the market is up, the trend is up, not only we will get 5 wave up, but if I go inside the first wave, which is that one here, that first wave, there are also 5 waves inside it. Okay. So every time the market moves in the direction of the main trend, we've got 5 waves, but inside each wave up, we also have 5 waves. And if I was zooming on that small wave 1 here, if I was zooming on that wave and say, for example, I was looking right now, I was looking at an hourly chart, and say, for example, I was zooming into like a 10 minutes chart, that wave 1 also would be in 5 waves. Basically, everything going up is in 5, from a 5-minute chart to a daily chart. And then when we get to the top, after 5 wave up, and we start a correction in 3 wave A, B, C, that wave A, this time is in 5 waves. And that wave C also is in 5 waves. That is important because it will help you identify where you are in the wave count. So this is what I call subdividing. Each wave subdivides into smaller waves. Why do we have 5 waves? Okay, this is something to do with psychology, the way people react in the market. if you recall what I said, before you get a 5-wave sequence, before that, prior to that 5-wave sequence, you get a decline. So the market is going down, down, down until it gets to the bottom of that wave 1. So you have to remember that when we are at the bottom of wave 1, there is a lot of pessimism in the stock market. If I take the example of the stock market, the market has been going down. There are very few bulls, many bears, and people are pessimistic about the future. And I'm talking more about a long-term chart here. And then what you get is you get a bounce, and that bounce is wave 1. So the trend is turning, but for many people, I would say for most people, it's not turning. People think that bounce is going to be followed by a decline into new low because we are in a downtrend. So this is why during that first phase, there is increased pessimism and stocks are undervalued and not many people want to buy. But then you get a pullback, which is a wave 2. And that second wave is very deep. It's very deep because, as I said, there are many bears and not many bulls at that stage. So people think it's going to make new low. So this is why the second wave of an Elliott wave is very deep. In general, it will retrace more than 50% of wave 1 and maximum 100% of wave 1. Okay, it's not very common to see a second wave ending near the top of wave 1. Most second wave will end very low. And that indication is very useful because if you want to go long for the third wave, you are not going to go long early. You are going to wait for a deep retracement because you know it's a second wave. And then the market will fail to make a new low and it will start to rally above the top of wave 1. And this is a third wave. And that third wave in general will be the longest. It will be the most powerful. Most powerful because there is increased participation. Because people realize that the trend has turned up. It's not going lower anymore. So this is why it's a powerful wave because there are many more bulls at that stage joining the party. So there is increased participation, and at the top of wave 3, technical indicators like the MACD, like the RSI will make new high. And that is important. We will see that later why it's important. RSI, MACD, and other momentum indicator will make their high at the top of wave 3. The next move is wave 4. Wave 4 is not deep. It is not deep because, as I have said earlier, there are many more bulls at this stage. So they are not going to let the price drop. The difference between wave 2 and wave 4 is that wave 2 there are many, many bears, where wave 4 there are less bears because people have realized the trend has turned up. So that wave 4 in general will retrace about 40% of wave 3. And then we get another rally to new high, and this is a fifth wave. During that fifth wave, the number of bulls will increase. The higher the market goes, the more people are attracted to the market. So this is why there is increased optimism, increased participation, many more bulls, maybe 80% bulls. But the thing is that the MACD or the RSI will make a lower high. Remember I said that at the top of wave 3, the technical indicator will make their highs, but when we are at the end of wave 5, they are not making new highs, they are making lower high. We call that a bearish divergence. That's when we know that the fifth wave is ending. It's ending because technical indicators are not making any more new high. And I'm going to show you an example of that bearish divergence on that that chart here, what you can see here is a decline in 5 waves. So the market is making a new low, and as you can see, we are in a bear market. So this is why when you are in a bear market, the declines are in 5 waves. And the main trend is done. So this is why the declines are in 5 waves. So what we get at the bottom of the chart, we've got a MACD histogram. And you can see here, that is a low, the low in the FTSE, because the chart above is the FTSE 100. So it's made a new low at the end of wave 5. But as you can see, the MACD is higher. In fact, the MACD made its low at the bottom of wave 3, when the FTSE was making the wave 3. So we have the momentum, downward momentum. MACD made a low at the end of wave 5. We've got a higher low. So it means that there is a bullish divergence, and that is warning us that the stock market will rally. Okay, so this is a good example of a divergence at the end of 5 waves. Now we are going to look at some example on gold, cable, FTSE 100, and Dow Jones. And each market I've selected a pattern. For example, gold is an impulse wave down, cable ending diagonal, FTSE 100 impulse wave and falling wedge, and Dow Jones ending diagonal. Those are names of patterns, Elliott Wave patterns. Now this is a chart of gold, okay, and gold is in a downtrend. So because it's in a downtrend, it should go down in 5 waves. So what we have here is the first wave. Then we got the bounce for the second wave. Then we get a decline, which is the third wave. Another bounce. And at that stage, some people may call this bounce wave 4. I didn't call it wave 4 because we are looking at what we call an impulse wave in 5 waves. And one of the characteristics of the impulse wave is that wave 4 doesn't go above the bottom of wave 1. It cannot do that. It's not possible. Okay, so here we have the impulse wave. So the one on the left is in a bull market. The one on the right is in a bear market. And on gold is in a bear market. So this is why it's going down in 5 waves. And what you can see here, we've got a gap. That gap, because this is one of the Elliott Wave rules. It says that wave 4 cannot overlap wave 1. It cannot overlap. What I mean by overlap, it cannot rally to above the bottom of wave 1. Okay, that is the rule. So when we have an impulse wave, it's not possible. Wave 4 cannot overlap wave 1. If I go back to my chart, that rally here, which is called wave A, is called wave A because it's not wave 4, because that is overlapping wave 1. I mean, it's not really overlapping. I've checked the price, and it's exactly at the same level. So yes, you can say it's overlapping. So because I saw that wave A is at the level of wave 1, it's not wave 4. I call it wave A. And why do I call it wave A? Is because wave 4 is tracing out a pattern, an Elliott Wave pattern. It could be a triangle, it could be a flat. But here, what it is, it's what we call a running flat. And I will show you why. Basically, that bounce here is wave A of a running flat in 3 waves, A, B, and C. So, in fact, wave 4 ended here. a bit lower. And in that case, it doesn't overlap wave 1. And why is it a running flat? Is because the market made a new low and bounced back. And if I go back to that pattern, which called running flat, it's here. That is the one here. That running flat. Again, the left one is a running flat in a bull market, and this is a running flat in a bear market, or bear trend, whatever you call it. And here, that pattern, gold is in a bear trend. So that running flat is that one. And you can see what the running flat does. So it's in 3 waves, A, B, C. But the second wave, which is wave B, will make a new low. Wave B makes a new low, and wave C and below the top of wave A. And this is exactly what happened on gold. You can see wave B makes a new low, and then wave C ends below the top of wave A. So this is what the pattern we have here. We have a running flat, and wave 4 ended here, where wave C is. So the next logical move was a decline for the 5th wave, and I put it here, that 5th wave. So if you are looking to go long, you would wait for that 5th wave to be complete before going long. As you can see, it's not the low. The low is further down. Why did I put wave 5 here? The reason why I put wave 5 here is that because that was my view at the time. When I did the trade, it was my view. I thought wave 5 had ended at that level. Just above 1216, okay? But I was wrong because sometimes, it's not easy to identify the unfolding pattern. Sometimes there are some variation and it's a bit more complicated. And that's what's happened with gold. In fact, but the reason why I wanted to show you that chart is because I did a trade and I didn't lose money on that trade. And it's just to show you how Elliott Wave analysis can help you avoid losses. Many people trade and they just hope that the stop loss won't get hit, but they don't really know, where they are in the pattern. With Elliott Wave analysis, either you are correct the first time and you make money immediately, or if you are not correct, you can get at no loss. And this is what I want to show you here, because when I saw that wave 5 here, and I thought, okay, that's the bottom, just above 1216. We saw a small rally, then a pullback, and I went long just like above 1220. I went long there, thinking that it's going to move up, okay? So there are 2 options here. The first option is a market rallies immediately, and I make money immediately, or there is a kind of dip like here, and then the market rallies, okay? And this is the way I trade. The way I trade is that I will make sure I am trading, opening a long position in gold near the bottom of the 5th wave. And if I am wrong and the bottom of the 5th wave is not complete, then I make sure there is a way I can get at no loss. And this is what I did, because if I put my stop loss well below that channel, you can see it's like a channel, I should be safe, because what happened with Elliott Wave is once the market has unfolded in 5 waves, okay, if there is another extension and the 5th wave it ends lower, it's not going to end much lower. That's what you need to know. So by using a wide stop loss, and I put my stop loss at near 1200, I was comfortable that the market wouldn't get there, even if I was, whether I was correct or wrong on the timing. And that is a good example because, a lot of people don't know where to put their stop loss. With Elliott Wave, there is a good, you know where to put your stop loss with a minimum damage. So what's happened here is that the market went lower. It didn't hit my stop loss, started to move up, and I made a profit in the end. Okay, so that's the way I trade. The way I trade is that if I do a trade, it's either an immediate profit, or if it doesn't turn into a profit immediately, at least I've got a plan whereby I may not get stopped. I may get into a temporary loss, and then as soon as the market goes my way again, I will close that trade at maybe at break even, or maybe at a small profit. Okay, so that was the first example. Now I've got another example. This one on the FTSE, and that chart of the FTSE, this is like 120 minutes chart. I showed that chart last month at the meeting, and this is a perfect Elliott wave, as you can see. The market hit 7,600, the top here, in early June. But if we look at that at the sequence, we've got this is a fifth wave, and inside it, as I said, the market is in a bull market. Okay, so it's moving up in 5 waves. It's a bull market, so we've got like a wave 1 circle here. We've got 2 circle, then 3 circle, 4 circle, and 5 circle. Okay, but if you look at inside each move up, it's also in 5 waves. That's what I call the subdivisions. Wave 1 is in 5 waves. 1, 2, 3, 4, and 5. Wave 3 circle is in 5 waves. 1, 2, 3, 4, and 5. Wave 4 is a correction. And then we've got wave 5 up, and that one too is in 5 waves. 1, 2, 3, 4, and 5. Now, the only variation here is that wave 5 is not an impulse wave. You can see that wave 1 is an impulse wave because 1, 2, 3, 4, 5. Wave 4 doesn't overlap wave 1. Wave 3 is an impulse wave because wave 4 does not overlap wave 1, but here wave 4 overlap wave 1. So it's not an impulse wave inside wave 5 circle. What it is here is called an expanding diagonal. Basically, we've got 3 types of pattern moving with the trend. The first one is the impulse wave, the second one is the ending diagonal, and the third one is the expanding diagonal, which we have here. Anyway, it was all perfect because we've got all the subdivision, and I was very confident we reached the top in the FTSE, and we made some short. We took some short and we made some money. Now I'm going to show you the second part of that FTSE chart, what's happened after the top. Okay, so the top was here, 7,600, okay? So from the moment that we have a 5 wave up in early June, I knew that it's going to go down because it should be in 3 waves. Like I said, when we are in a bull market, the market declines in 3 waves. However, that is like for me, I knew it was going to be more than 3 waves because what happened is when you get to the end of the bull market, the decline is now in 5 waves because we are in a bear market. So it's a bit like saying we are not in a correction here. That pullback in June, it's not a correction that will lead to new highs because I assume that now we are in a bear market. You see, if I go back before to the previous chart, you can see that wave 5 here, that wave 5 and that wave 4. So it means that the market has been moving up for a long time and it's reached a final wave, which is a wave 5. And according to my analysis, based on long-term chart, I assume that this is the end of the bull market. So if I assume that this is the end of the bull market, then the next move done will not be in 3, but this time a new cycle will start where we are in a bear market, and that decline will now be in 5 waves, not in 3. So this is why on that chart, I'm looking for 5 waves done. 1, 2, 3, 4, and 5. This is what I was looking for. And what's happening now is that we got like the first wave done, okay. And what I noticed during that first wave done is it's not in 5 wave. You know, it should be in 5 wave. It's not. It's 1, 2, 3 here. So basically, at that moment, I wait for confirmation, because the thing is, if he was going down in 5 waves, you wouldn't get that big spike here. You know that wave A in bracket here, it's gone too high. You know, it's gone above the bottom of that first wave. Because if wave 1 circle is in 5 waves, that level here is the first wave. So it shouldn't go above that level. The fact that wave A has risen above that level, it means that that wave is complete. Okay, we've got some kind of complex pattern. And if I wait and see how things unfold, and what we get here is that a consolidation, then a move down, a new low, and then a big rally in 5 waves. And you can see the 5 wave is clear. It's got 1, 2, 3, 4, 5. Okay, so what we have here is a bounce, wave A, a decline to new low, wave B, and a rally in 5 waves, wave C. So again, I go back to my chart library, my pattern library, to see, and that is called an expanded flat, that pattern. And this is it. This is the one here. Expanded flat in a bear market, because I assume that the FTSE is in a bear market. So what that pattern says, I mean, what it shows is that you get a wave A, then wave B makes a new low, and wave C ends above wave A, and also wave C is in 5 waves, as you can see here. Okay, so you've got A, B to new low, C to new high in 5 waves. This is exactly what we have on the FTSE. A, B to new low, and C in 5 waves. Okay, so that is wave 2 now. So now I understand what's going on, you know, by deduction, because I can see that we've got here a move down here, which is wave 1. Then we've got wave 2 here. Then I know that now we are going to get wave 3 down in 3 waves, because this is like a falling wedge. A falling wedge is like when the market decline within 2 converging trend lines. And this is what's happening. So you can see this is why that one was in 3 waves, because each wave in a falling wedge is in 3 waves. So we've got 1, 2, 3 here, we've got 1, 2, 3 here, then we've got 1, 2, 3 here. So here you can go short at that level. Short because wave 2 is complete. We are in wave 3 down in 3 waves. Then we get a bounce for the 4th wave. And remember, the trend has turned up. Okay, the trend has turned up. It means that the decline is in 5 waves, not in 3. So then we get that bounce on the line, the upper line of the falling wedge, and then a decline again. But this time, this is not textbook. You know, it's not textbook because you can see that the wave 5 in a 5 circle, which is a final wave of the decline, did not make a new low. You can see it just ended above wave 3, which is not textbook. Because normally what should happen, it should end below. It should end near that line, the lower line, and it didn't. But what I'm showing you here is the reality of trading. You know, I'm not going to show you like textbook pattern because when you start trading, that is the reality. This is what you get. Okay, so this is what I wanted to show you, that you know, and also I wanted to show you how you trade those patterns, and when you when if you are wrong, how you get out at no loss, which is the main thing, you know. So for example here, I was looking to go long near that lower line. And of course, the market never went to that level, so I didn't trade. I missed that move up, you know, because I was going to buy for the bounce. But that is not the main thing, you know. Missing a move is not important. It may be frustrating at times, but it's not important. The most important thing is not to lose money. And this is what I focus on all the time. You know, I am not this typical trader who says, okay, I'm going to buy and have my stop loss there, and okay, if he goes to my target, I make money. If he goes to my stop loss, I lose money. I am more demanding than that, because when I'm wrong, I don't want my stop loss to be it. You see, I always do a trade in a place, in a position where if I'm wrong, that stop loss is not going to be hit. If it's hit, then there is nothing I can do, I'll lose, you see. But most of the time it's not it. Or it's going to be like less than I should lose. For example, if my stop loss is 40 points, I may get at a loss of 20 or 10 if I'm wrong. You see what I mean? And that makes all the difference because your profit are always there. But if your original stops are never hit, I mean, sometimes they are hit, but if they are hit, maybe, I don't know, like 40% of the time, the rest, 60% of the time, there are smaller losses, even smaller losses, which make all the difference. This is what you will get when you follow my strategy, my low risk strategy. Now we get the bounce in the FTSE, and I predicted a rally to 5,000. Sorry, I predicted a rally to 7,500, and I can see we got there just now. When I look at the screen, the FTSE has just hit 7,500. Sorry. Yes. Here is a report by FTSE term forecast. Here you can see I expected a rally to 7,500. Okay, and a decline. And here is a pattern I was discussing. Here again, you can see with wave 5 failing to make a new low. Okay, but at the end of the day, you get some trade. You make profit on some trade, and then there are some you will miss, like this one. I was waiting to go long, and I missed because it didn't go low enough. Now I'm going to show you another example of how to use the Elliott Wave to maximize profit. Now this one is on the cable, and cable is moving up in 5 waves: 1, 2, 3, 4, and 5. Okay, but you can see that it's not an impulse wave. It's not an impulse wave because wave 1 and wave 4, look at wave 4. Wave 4 has overlapped wave 1. Wave 4 is below, so it's not an impulse wave. The alternative here is an ending diagonal. We call it ending diagonal. And I'm going to show you the pattern in my library. Yeah, ending diagonal. Okay, so that one is a bull market because cable is rising. Cable is going up. And that is that pattern here in 5 waves, and it's like a rising wedge. It's like a wedge, 2 converging trend lines. Okay, so this is what we have here. That ending, and this is a terminal pattern. It's terminal pattern because that ending diagonal occurs in the 5th wave of a rally. Okay, but it can also happen in the wave C of a rally. Okay, not just in the 5th wave, but in general, it's a terminal pattern. It means that when you get those 5 waves between the 2 converging trend lines, the market will fall hard. So that is a pattern here. And the other characteristic of ending diagonal is that each wave inside it is in 3. Okay, so again, by looking at the chart, you understand where you are. You are not lost. You know what the next move is. Like here, 1, 2, 3. So wave 2 is in 3. Wave 3 is not very clear if it's in 3, but you can say it's 1, 2, 3. Then wave 4 is more like a double zigzag, okay, which is in 7 instead of 3. Because here you've got 1, 2, 3, then 4, 5, 6, 7. Okay, double zigzag instead of zigzag. 1, 2, 3 is a zigzag. 1, 2, 3, 4, 5, 6, 7 is a double zigzag. Like zigzag here. 1, 2, 3, zigzag. Double zigzag. 1, 2, 3, 4, 5, 6, 7. Okay? So that is a double zigzag. And then here, I know that the market will rally. Okay, because the next move is wave 5 in 3 waves, A, B, C. And when you get to that level here, above 130, you know that the market will pull back. Cable will, because I expect a final rally in 3 waves, not one. At the top of wave A, it's only 1 wave. So I know that there will be some kind of pullback. So here is a good place to go short, and below near the bottom of wave B is a good place to go long. And if I go to if I zoom on that wave B, I'm going to zoom on that wave B here. You can see the subdivision inside that decline. So we've got a wave A, and then you get a double zigzag, A, B, C, X, A, B, C in 7 waves. 1, 2, 3, 4, 5, 6, 7 waves. So when you see that 7 wave here, you can start going long again, because at that point, wave B has retraced 50%. This is a 50% retracement of wave A, and this is a normal retracement for wave B. So that's another good place to go long. Okay, and now what we are seeing is a rally. Okay, the final rally to the top, and we may have peaked. We may have peaked in cable because that high here above 31, I think, is probably the end of the rally, because now we can see that today cable is done today. So the decline is extending again. So it's possible that the trend has turned down without, I say without reaching the upper line of the pattern. Because the upper line was here. You can see the upper line was above 32. And it's peaked below that, you see. So it's possible, a bit like the FTSE chart, where we failed to go to new low, that one. Wave 5 failed to reach the lower line and rallied. We may have the opposite situation on cable, you see, where it's peaked just below that upper line, and now it's going to go down. Okay, so that's all the pattern I wanted to show you, and how you can use Elliott Wave to time your entry into the market. And it's very precise, as you can see. The only thing is you need to be able to understand and learn Elliott Wave, and you need many years experience, because it takes, I wouldn't say, maybe not many years, but many months, I would say, of watching the market and identifying the right pattern, okay? Because as you can see, there are many variations. It's not just an impulse wave. It can be an ending diagonal, it can be an expanding diagonal, it can be a flat, running flat, an expanded flat. So all those patterns, you just learn them, and then it's a question of practicing in the market to recognize those patterns, but they are very useful.
Thierry?
Yes.
Can we take just 1 or 2 questions if you've got time? We've still got 7 minutes.
Maybe it's better if we take the question at the end, or?
Sure, no problem at all. Let's
I'm going to finish quickly anyway, so we can have some question, yeah?
And we'll come back. So if you have any questions, now would be the time maybe to tap them in, and then we'll come back to the questions in 5 minutes. Thank you.
Yes, so just a quick word about this strategy I was telling you. First, you saw the timing using the Elliott Wave, and that is the main thing, okay? And then that strategy I run is based on going long and short the FTSE, cash and futures, and also trading options, okay? So it's a strategy I run in the E-Yield traders community. The community is a group of traders, and they follow my instructions, they follow my trades, they follow my analysis in real time, like anytime, really. You know, like if I see something now, I just put it on the app. It's basically, the trader community is a messaging app, so you can download it from the App Store. You know, you can put it. It goes on like iOS, Android phone, on PC, and once you are in this app, you log into the app, and you will see people chatting, asking me questions, and I answer their question, and I can show you quickly. You know, this is the app, in fact, here. You can see that I'm chatting to questions, you know. What the FTSE is going to do, because as I said, we trade the FTSE only on that app, you know. That strategy is like long short the FTSE, and also options. And you can see also my trades. So when you click at the top, you can select the group you want to see. Like the general discussion group is that one, yield traders community. And then if you go to Thierry's trade, this is trades. So people will copy those trades. For example, I said today I closed a small FTSE September at 74.17. So this is my current position at the moment. I'm short on the FTSE cash, long call, short call. So I've got two calls, one short, one long, and one short on the FTSE, okay? So basically, it's a way of communicating with people, telling them, giving them my view on the market any time of the day. Sometimes even at night, people will ask me questions at 9 p.m. You know, if I have time, I answer them. So it's like constant, really, you know. And they can copy my trade at the same time. So what is the yield traders community? And if you want to try it, you know, there is an offer. That link, you can copy that link, or maybe, you know, Simon, maybe you can send you the link, and you just register for a 2 weeks free trial. And this is only for members of Round the Clock Trader. Okay. Now, the other thing about that, as you've noticed, the other thing about that. Why do I say it's low risk? Because I tell people that I can't give them the quantities to trade, but I tell them in advance. They should be what exposure they should have. In general, the exposure is £1 per 1,000 in their account, so they know that. So like that, they don't take huge risks. You know, if there is something going wrong, they are not going to lose much. You know, like for example, even here I say 1/3. You can see. 1/3 is a small trade. It's like if, say, for example, your normal size is like £10, you know, 1/3 would be like £3, a third of 10, you know. So this is I guide them on the exposure so that they don't take huge risk. You see what I mean? So that's what they get with that traders community. And you know, options. Many people are not familiar with options, but I explain everything. I can send you links about how to, you know, how to trade an option. I can give you example. I can tell you where to go on the platform to get the option. It's very simple, really, you know. But basically, we trade option, FTSE September, and FTSE cash. Okay. So now, if you have any question, please feel free.
Okay, thanks, Thierry. Yeah, just a few questions. First of all, well, Graham says that cable on the higher time frames, it varies on the weekly and the monthly. Where do you see cable rolling over and turning bearish, or do you?
Well, that according to my chart, I was expecting a move to above 132, but this doesn't look like it's happening now because it's pulling back. Okay, because today we had this retail sales report, and I think this is the top. I think because we can see that the rally, which is wave 5, is in 3 waves, A, B, C, and this is what it should be. It should be in 3 waves, that final move up. So I am not quite sure if we are going to get another rally to 32 to complete that 5th wave, or it's starting already because it's going down, you see. But one way or another, the next move will be a large decline going back to the low, the bottom of wave 1, which is like 120. Okay, so my target on cable is a big decline, but that will take what, many months to do that. It's not going to happen in the short term.
Richard, he says, how far up does your analysis spell out the FTSE one? How far up does your analysis spell out the FTSE 100, where it will peak next?
In general, I look at the short term only, okay? But from time to time, I will post chart about the long-term trend, okay? But it's mainly over the next, I would say, 4 weeks. Is that the question?
I think Richard, I think that's what you're. He said I'm asking short term, so.
Short term. short term, I will tell people where I think is going, like tomorrow, in the next few days, in the next week. Basically, I cover all those short term options, up to a week.
Okay, so pretty short.
And also, and also when people are on the app, on the app, I cover intraday as well, because they ask me a question about even where do you think it's heading now? They will ask me those questions.
Okay, so in terms of in terms of looking ahead, you're looking at the day, the weekly, and the daily.
Like I cover from intraday to the next week or two, already.
Okay. Okay. Which platform do you trade FTSE options on? Asks Joe.
The platform is IG, the IG platform. It's the best platform for options. And also, what happens is when you join, if you join the service, the traders community, when you join the traders community and you open an account through us, you get a discount on your subscription. Okay. So if you want to open an IG account, don't open it now. Just, I can send you a link, because with that link, later on, if you subscribe, you will get a discount on your subscription.
Okay, so IG. Gina says wave 4 is normally messy. Would you agree with that?
No, wave 4 is not messy. Wave 4 tends to be like a triangle. It tends to go sideways. Because, again, it's something to do with the psychology of trading, because if you remember what I was saying about the top of the third wave, there are so many bulls, and because there are so many bulls, when the market starts to pull back, they will support that market. They will come and buy and buy. So this way it tends to go sideways, like a triangle, and then after that it breaks higher.
Indeed, indeed. Well, Thierry, I think we are just about out of time, so we'll leave it there. Thank you for coming to join us again. We have posted the links to that offer that you've kindly offered people on the webinar a chance for 2 weeks in the community with that link. I've posted that in the message box, so anybody that's wants to take that up, you just click on there, and Thierry will be able to sort you out with that 2-week trial. But thank you very much indeed for coming to join us, and hopefully we can hear from you again at some point. But meantime, thank you very much. I'm going to take the presenter role back.
And thank you very much for listening.
It's our pleasure. Thank you, Thierry. Bye-bye for now.
Thank you. Bye.